Picture this. It is exactly 9:30 in the morning, Shanghai time. The markets have just opened. Suddenly, a massive red candle appears on the silver chart, wiping out weeks of gains in mere seconds. This was not a panic sell by retail investors. This was a precision strike. In that brief moment of chaos, a single entity, a Chinese whale, walked away with a profit of $144 million. But here is the twist. While the price of paper silver crashed on your screen, the physical inventory at the Shanghai Gold Exchange did not increase. It actually decreased. This is a mathematical impossibility in a free market. Price down, supply down. Someone is lying to you. Welcome to the dark side of the commodities market. I am your guide to the forensic evidence that the mainstream media ignores. Before we open the ledger, I need you to do something for me. Close your other tabs, turn off the television, put your phone on silent. What I am about to show you is not a prediction, it is a transfer of wealth happening in real time. Listen closely, I also want to verify the reach of this data. Are you observing this market crash from New York, London, or Singapore? Let me know in the comments below. To understand how one entity extracts $144 million from the market in a single session, we must look beyond the price chart. We must look at the plumbing of the financial system. This was not a trade based on fundamental analysis. This was a structural exploit of the liquidity mechanics between East and West. Let us dissect the anatomy of this trade. To generate a profit of $144 million on a short position, the notional value of the contracts dumped onto the market had to be astronomical. We are estimating a position size exceeding $1.5 billion in leverage. In the world of forensic finance, we call this the paper hammer. Here is how the mechanism works. It relies on the disconnect between the Shanghai Futures Exchange and the COMEX in New York. The whale knows that the global spot price of silver is largely determined by paper contracts traded in the West, not by the physical metal changing hands in the East. At exactly 9:30 in the morning, the algorithm initiated what is known as a spoofing cycle. The whale placed massive sell orders just above the current market price. These orders were never intended to be filled. They were phantoms. Their only purpose was to signal to the high-frequency trading bots, the AI algorithms that run the market, that a massive supply glut had just appeared. The bots reacted instantly. Seeing the wall of sell orders, the algorithms flipped from long to short in microseconds. They began selling aggressively to front-run the whale. This self-fulfilling prophecy caused the price to cascade downwards. This is where the trap was sprung. As the price crashed through key technical support levels, it triggered the stop-loss orders of retail investors and smaller institutions. Millions of ounces of paper silver were automatically sold by panicked traders trying to limit their losses. This is the liquidity the whale was hunting. You see, a whale of this size cannot just enter or exit a position whenever they want. They are too big. If they try to buy or sell, they move the market against themselves. They need a chaotic event, a flood of volume, to hide their movements. By triggering your stop losses, they created a pool of liquidity deep enough to cover their short position and book that $144 million profit. But let us look deeper at the leverage ratio. The silver market is notorious for its leverage. For every 1 ounce of physical silver sitting in a vault, there are approximately 356 ounces of paper silver traded on the exchanges. This creates a fragile ecosystem. The whale is not trading metal. They are trading promises. When they short the market, they are essentially selling promises of silver that do not exist. In a rational world, this would be illegal. It is selling something you do not own, but in the derivatives market, it is standard operating procedure. They flooded the market with these paper promises, diluting the perceived value of the real metal you hold in your hand. Consider the concept of backwardation. Usually, the future price of a commodity is higher than the spot price, to account for storage and insurance. However, during this crash, we saw a flicker of backwardation. The spot price remained stubborn while the futures price collapsed. This indicates stress in the physical delivery mechanism. The paper market was saying the price is dropping, but the physical market was screaming for supply. The whale exploited this divergence. While they were shorting the paper market to drive the price down, our forensic data suggests they were simultaneously using separate accounts to accumulate physical inventory at the depressed prices. This is the classic shake and bake strategy. They shake the weak hands out of their positions using paper leverage, and then they bake the profit by acquiring the real asset at a discount. You must understand that the $144 million did not come from thin air. It was a wealth transfer. It came from the accounts of pension funds, retail stackers, and smaller speculators who were leveraged long. When their margin calls hit, the whale was there to collect. This highlights the extreme danger of playing their game with their rules. When you trade paper silver on leverage, you are stepping into a cage with a predator that can see your stop loss, see your margin limit, and has the capital to push the price exactly to the point where you are forced to capitulate. The data from the clearinghouse shows that open interest did not decline significantly after the crash. This implies that the whale has not left the casino. They have simply re-racked their chips. They have reset the board for the next round. The suppression of the price serves a larger industrial purpose, which we will discuss in the next section. But purely from a financial forensic standpoint, this was a masterclass in market manipulation. They use the liquidity vacuum of the Asian morning session, where volume is typically thinner than the New York or London sessions, to maximize the impact of their sell orders. It requires less capital to crash the price at 9:30 Shanghai time than it does at 9:30 New York time, and efficiency in execution, ruthlessness in intent. To fully grasp the magnitude of this $144 million heist, we must place it on the timeline of financial history. This is not the first time the silver market has been turned into a crime scene, but the perpetrators and the motives have changed dramatically. Go back to 1980. The Hunt brothers, two oil tycoons from Texas, attempted to corner the silver market. Their strategy was brute force. They bought as much physical metal and futures contracts as they could, driving the price from $6 to nearly $50 an ounce. Their goal was profit through price appreciation. They wanted the price to go up. The establishment crushed them by changing the rules of the exchange overnight, forcing them to liquidate only. I'd fast forward to the era following the financial crisis of 2008. The market was dominated by the desk at JP Morgan. For years, they were the whale. Their traders were eventually charged with racketeering and spoofing. The exact same technique we just witnessed in Shanghai. But here is the critical difference. The Western banks manipulated the price to skim profits from the volatility. It was purely a financial game. What we are witnessing now with this Chinese whale is something far more strategic and dangerous. The center of gravity for precious metals pricing is shifting from west to east, from New York and London to Shanghai and Beijing. But the motive has inverted. Why would a Chinese entity, backed by state interests, want to crash the price of silver? On the surface, it seems counterintuitive. If you hold an asset, you want its value to rise. However, you must stop thinking like a Western day trader and start thinking like an Eastern central planner. China currently controls over 80% of the global solar panel manufacturing supply chain. They produce the vast majority of the world's electric vehicle batteries and electronics. Silver is not just a monetary metal to them, it is a strategic industrial ingredient. It is the second most used commodity in their high-tech manufacturing base, right after oil. If the price of silver were to explode to $50 or $100 an ounce, as true supply and demand fundamentals suggest it should, it would decimate the profit margins of Chinese manufacturing. It would make their solar panels too expensive for the rest of the world to buy. Therefore, this $144 million profit from shorting is merely a bonus. The real objective is price suppression. By crushing the paper price on the exchange, they effectively subsidize their entire industrial base. They keep the input costs low for their factories. This is a weaponized use of the futures market. They are using paper contracts to suppress the cost of a physical reality. While Western investors look at the chart and see a bear market, Chinese industrial planners look at the same chart and see cost control. This represents a tectonic shift in geopolitics. For decades, the West suppressed gold and silver prices to protect the validity of the fiat dollar. If gold flies, the dollar dies. That was the old rule. Now, the East is suppressing the price to ensure dominance in the green energy revolution. Then we are seeing a transfer of power. The Shanghai Gold Exchange was supposed to be the venue for physical price discovery, a place where metal actually changes hands. But with this latest event, we see that the infection of paper derivatives has spread. The Chinese whale has learned the dark arts of Wall Street, spoofing, layering, and front-running, and they are using these tools with lethal efficiency. The victim in this geopolitical chess game is the retail investor who believes the price on the screen reflects reality. It does not. The price on the screen is simply the price at which the dominant power allows the metal to flow to their factories. You are not trading in a free market. You are trading in a subsidized supply chain managed by a state-sponsored algorithm. While the Chinese whale plays games with paper contracts on the screen, a relentless, irreversible reality is unfolding in the physical world. This is where the forensic analysis reveals the true crime. The disconnect between the paper price of silver and its industrial utility has never been wider. To understand why this crash is artificial, you must look at the burn rate. Silver is not just a monetary metal like gold. It is a strategic industrial material. It is the single most conductive element on the periodic table. You cannot build the modern world without it. And right now, the modern world is consuming it faster than we can mine it. Let us look at the solar industry. This is the heart of the beast. The new generation of solar technology, specifically the TOPCon and HJT cells, requires anywhere from 50 to 80% more silver per panel than previous models. In the year 2023 alone, the photovoltaic industry consumed roughly 193 million ounces of silver. That number is projected to smash through 230 million ounces in 2025. Think about that. Nearly 25% of the entire global annual supply of silver is vanishing into solar panels. And here is the critical part. This silver is rarely recycled. It is pasted onto silicon wafers, installed on rooftops, and locked away for 30 years. It is effectively removed from the ledger. It is gone. Then we have the artificial intelligence revolution. Everyone talks about the chips, the data centers, and the energy consumption. But nobody talks about the hardware infrastructure required to transmit that electricity. AI servers run hot. They require premium connectors. They require silver. The demand from the electronics sector is becoming inelastic. This means that even if the price of silver doubles or triples, Apple, Samsung, and Nvidia will still buy it. They have no choice. There is no substitute that conducts electricity as efficiently as silver. And let us not forget the military-industrial complex. In every Tomahawk missile, in every fighter jet avionics system, there is a significant amount of silver. It is used in the guidance systems, the contacts, and the batteries. As geopolitical tensions rise globally, defense budgets are exploding. This translates directly into physical silver consumption. So, we have a scenario where demand is hitting record highs, yet the price is being smashed by a whale in Shanghai. Why? Because China knows this data better than anyone else. They are the world's factory. They know that if the price of silver were allowed to float freely, it would likely be trading at $50 or $100 an ounce right now. That would crush their manufacturing dominance. This explains the anomaly we saw at the beginning. The price crashed, but the inventory at the Shanghai Gold Exchange fell. The whale used the paper crash to scare you out of your position so they could scoop up the physical metal to feed this industrial hunger. If you call a bullion dealer today, a real person who sells actual metal, and ask to buy silver at the spot price you see on the screen, they will laugh at you. The premiums on physical coins and bars remain stubbornly high. This premium is the real market talking. It is the spread between the fake paper price and the real physical price. The dealers are running low on inventory. The sovereign mints are delaying shipments. We are seeing delays in delivery for the American Silver Eagle and the Canadian Maple Leaf. The paper market is a mechanism of misdirection. It is designed to make you think silver is abundant and cheap. But the industrial data proves that silver is scarce and critical. The whale made $144 million betting that you would believe the lie. They are betting that you will look at the red candle and sell, handing over your claim on the only asset that is indispensable to the future of energy and technology. Here, they are draining the vaults of the West to build the energy infrastructure of the East, and they are using the paper market to pay for it at a discount. We have now dissected the anatomy of a $144 million heist. We have traced the digital footprints from the high-frequency trading servers in Shanghai to the drained vaults of the West. What we have found is not merely a market anomaly, it is a systemic fracture. The event that occurred at 9:30 in the morning was a warning shot fired across the bow of every retail investor in the world. The forensic conclusion is undeniable. The price discovery mechanism for silver, and indeed for most commodities, is broken. It has been captured. It is no longer a function of supply and demand physics. It is a function of leverage, algorithm dominance, and geopolitical strategy. The price you see on your screen is a lie. It is a number generated to facilitate the transfer of physical assets from the many to the few. As we look forward, we must navigate through two distinct and dangerous probabilities. These are not guesses. These are the only two mathematical outcomes left for a system that is leveraged 356 to 1. You need to understand both scenarios intimately to survive what is coming. Scenario A is what I call the paper stranglehold. This is the scenario of prolonged pain. In this future, the whale continues to utilize their immense balance sheet and state-sponsored credit lines to cap the price of silver indefinitely. They will use every rally, every spark of hope, as an opportunity to add to their short positions. Their goal in scenario A is psychological warfare. They want to demoralize you. They know that retail investors are impatient. They know you are looking for a quick return to pay off debt or buy a car. By keeping the price flat or suppressing it below the cost of production for another 6 months, or perhaps another 2 years, they are counting on you to capitulate. They want you to look at your dead money. They want you to feel foolish for holding a metal that does not move while other speculative assets pump. When you finally break, when you finally sell your position in frustration, that is when they win. That is when they step in and buy your claim. In this scenario, the price stays low until the East has drained the very last ounce of deliverable silver from the Western vaults. They are playing the long game. They are thinking in decades while you are thinking in days. Scenario B is the physical break, also known as the force majeure event. This is the scenario the bullion banks and the exchanges fear most. It happens when the leverage snaps. We saw a preview of this during the London nickel crisis in March of the year 2022. In this scenario, the physical inventory at the COMEX and the Shanghai Gold Exchange hits critical zero. The industrial buyers, Tesla, Samsung, the solar manufacturers, stand for delivery, and the vault operators have to admit the vault is empty. When this happens, the exchange will not let the price go to the moon. Do not be naive. They will declare a force majeure. They will change the rules in the middle of the game. They will settle your paper contracts in cash. They will say, "We cannot deliver the silver you bought, so here is the cash equivalent at the last traded price." You will get your fiat currency back, currency that is rapidly losing to purchasing power, but you will not get the metal. The real metal will disappear into the black market, trading at premiums of 100%, 200%, or more above the broken paper price. If you are holding paper silver when scenario B hits, you do not own silver. You own an unsecured loan to a bankrupt casino. So, how do you engineer a survival strategy in a market that is rigged against you? The first rule of forensic finance is to remove counterparty risk. That $144 million was extracted from traders who were playing inside the system. They were trading on margin. They were using leverage. When you use leverage, you are renting your position from the bank. You are giving the algorithm the power to liquidate you. You cannot win a knife fight against a supercomputer that can see your stop-loss orders. The whale knows exactly where the pain points are. They have the capital to push the price exactly to the number that triggers a cascade of forced selling. Do not be their liquidity. Do not be the fuel for their profit engine. The only winning move is to stop playing their game and start playing your own. You must become your own central bank. This means taking possession of the asset. When you hold physical silver, whether it is sovereign minted coins like the Silver Eagle or industrial bars, you eliminate the counterparty. There is no algorithm in the world that can flash crash the metal sitting in your private safe. There is no margin call on an ounce of silver buried in your backyard. When you hold the physical metal, you are indifferent to the paper price manipulation. In fact, you should welcome it. When the Chinese whale smashes the price down to subsidize their solar factories, they are inadvertently subsidizing you as well. They are putting the most strategically important metal on the periodic table on sale. Do not look at a red candle and feel fear. Look at it as a window of opportunity that is closing fast. Every time the price drops, it is an invitation to exchange your paper currency, which is being printed into oblivion by the trillions, for a finite resource that is essential to the future of energy, technology, and defense. We are witnessing the end of an era. Among the era of paper derivatives determining the value of real things is coming to a disorderly conclusion. The mathematics of a structural deficit cannot be hidden forever. The world is burning more silver than it mines. The above-ground stockpiles are bleeding out. Eventually, the physical reality will overwhelm the paper manipulation. It might happen next week, or it might happen in 5 years. But when it happens, it will happen overnight. There will be no warning. There will be no time to buy. I need you to protect yourself. Do not seek to get rich quick. Seek to survive what is coming. The transfer of wealth from the impatient to the patient is underway. The transfer of wealth from the west to the east is underway. Make sure you are on the right side of the ledger. I have compiled a full confidential dossier on the Shanghai inventory depletion rates and the specific industrial burn rates we discussed today. It includes the data points the mainstream financial news refuses to show you. If you want to see the raw evidence yourself, I have pinned the link in the description below. Do not trust the price on the screen. Trust the weight in your hand.